Hello Trade Pros, it's Victor from Trade Pro Academy, and today we've got another video for you. Today we're going to be talking more about options. So the main topic of this video is how to trade quarterly earnings reports. As everyone knows, earnings reports can be super volatile events and they are not really tampered with in the trading community. Holding positions through earnings reports can result in substantial losses or substantial gains. It does come down to a guessing game at some point. So today I'm going to be talking to you about how do we trade earnings reports with options to mitigate that risk. So let's just jump right into it. So I'm just going to give you a quick rundown on what earnings are, and then we're just going to get right into this. So again, earnings reports come out quarterly, usually on publicly traded companies, and such as companies like Apple right here. You can see their earnings report did come out on January 29th, 2019, and there was a surprise beat by $0.01 or a cent. So their estimated earnings were $4.17, but their earnings came out at $4.18 per share. So the earnings report includes earnings per shares, like I just mentioned, their net sales, earnings from continuing operations, and net income. Also, expected earnings growth in future quarters. So if they expect to earn more, that could also influence the stock's price. So if they expect to drop earnings in the next few quarters, then we could see some bearishness. Another phenomenon that happens in earnings reports is that momentum usually carries to that side of the report. So you can see right here, the earnings report came out, slight beat. You can see a nice little gap here on Apple and the continuation move a little higher. I'm not saying the continuation is going to continue forever and skyrocket, but usually there's continuation in the momentum of that report. I'm going to be explaining how we use options to take advantage of earnings volatility. So that's the key right here, implied volatility on options. So as you may know, if you've taken some of our courses through options trading, when implied volatility increases, the premium or the worth of that option, no matter the put or the call, increases in value as well. So the strategy we're going to be talking to you today takes advantage of both sides of the options trade. And ideally, we want to see price flat going into the earnings report. Again, that may not happen, but either way, one of the legs of the option might be substantially more profitable than the other loss. So let's get right into it. So what do I mean? We're going to be using Interactive Brokers for this demonstration. So Interactive Brokers is a great options trading platform and it has a great implied volatility tool. So leading into earnings, we expect a lot of uncertainty. There's crazy expectations around earnings reports, especially around tech companies and medium to smaller cap companies. So you do see implied volatility increase as earnings approach. So earnings in general is a very, very uncertain, volatile report. So we look to take advantage of the increase in implied volatility leading up to that report. So what we do is we construct a straddle on options. So what is a straddle? A straddle involves a strategy builder here, and we're going to take the long call and long put at the same strike of an option. So we're going to be using Apple here as an example, and their earnings report is, I believe, in March. So let's just look at the June and July options chains. But I'm just going to explain the basics of a straddle before we go back into our implied volatility strategy and construct this whole earning strategy for you. So the straddle is very basic. We take a long call position, and on the other side of the same strike, we'll take a long put. So when we construct that in our strategy builder here, you'll see a little V shape. This is what the straddle looks like. And just to demonstrate here, if we submit order, we're going to see our profit and loss potential of the straddle. So let's enter a limit price. Again, this isn't exact. I'm just doing this for demonstration purposes here. If you guys want to learn a little more about the straddle, just pop into our options course. We've got a great straddle and strangle explanation there. So this is what a straddle looks like in a P&L diagram. So this is our strike here at 175, and the break-even point on one side is going to be at this 194 or 95 area, and the other side, the 155 area. So when price goes above or below either of those thresholds, we expect one side to increase in value while the other side lose in value. Hopefully the increase in value mitigates the loss in value. You can see right here If we go into April, let's say, and if the underlying drops 10%, the gain is $207. If the underlying goes up 10%, the gain is $169. So in the regular straddle, you don't really want to see price stay in between these areas. You want to see price move to one direction or the other. But in this earnings strategy, you're going to see it's a little different. Let's go ahead and cancel that, and then we're going to go into another options tool right here. So in Interactive Brokers, if we open a new window and we go into options analysis down here, and we go into volatility over time and implied volatility by expiry. This is a great little tool here that we use a lot during our earnings reports. So implied volatility by expiry, let's use Apple here. And you can see that it's dropping off right here. But if we move along a little, remember when the last earnings report was? It was January 29th, I believe. So right here, this was about January 22nd, 23rd. So January 29th, right here, you see this little spike in implied volatility. This is right when the earnings report hit. So our strategy is to take advantage of the increase in implied volatility. So what you're looking for is stocks, maybe tech, maybe smaller mid-cap stocks that increase their implied volatility as they approach earnings. The strategy that we take involves taking a long straddle position about 30 to 45 days before the earnings report. So you'd be getting that early March somewhere at the end of December or at the beginning of January. Considering the end of December held a lot of volatility, something around early January would have sufficed. If you picked up the options long straddle position somewhere in early January, you can see on the early March implied volatility was at around 29-30%, and it spiked at 35% leading up into the earnings report. So the idea behind this strategy is to take the position when implied volatility is low and get rid of it before the earnings report, before you hold on to that risk. And with the implied volatility increasing, both value of the options on the call side and the put side will increase in value. And the best scenario would be price to stay a little stable throughout that period so you can just absorb all the gains from the implied volatility move. Here's another example. We pulled up AMD. AMD had pretty volatile earnings, and again, there's a spike in implied volatility depending on the expiry date. So we've got around 70% volatility already, implied volatility, and it spiked all the way up to the low 80s right before the earnings report. So the idea is getting along the straddle position somewhere early January and getting rid of it right before the earnings hit and taking advantage of that implied volatility. So we've got earnings season coming up in May, end of April. So we're going to keep an eye out on that. Stocks, remember, like Apple, AMD, some tech companies, some mid to small caps are going to have more implied volatility leading up to earnings. So remember, 30 to 40 days prior to earnings, you're going to want to get into or look to get into a straddle position to take advantage of that implied volatility leading up to earnings. And the key is to dump the position right before earnings, a day or two before earnings, to capture that move and not hold throughout the earnings report, because one, implied volatility drops off right after earnings, just decimating the value of your options position. You can see right here, a day after, implied volatility fell from 80% down to 50 or high 50s on the same options expiry. So you got to get rid of this position right before earnings hits, because after the earnings report comes out, the uncertainty's gone. That means implied volatility's gone, and that eats away at your profits that you've made. So again, on Interactive Brokers, it's a great little tool. Siphon through some of the stocks you like, some of the stocks that had prior volatile earnings, and see how they perform historically leading up to earnings in terms of implied volatility. Hope you guys enjoyed this quick little options strategy for earnings. Check out our options course in our swing trader package or in any other package at TradePro Academy. And this was Victoria from TradePro Academy. I hope you guys enjoyed this video. Hit that like button, subscribe, and hit that little bell to notify you when we go live every morning on YouTube for our morning market analysis live. Take care, everyone.